welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and Independent Advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to Nucleus Insights, our next instalment of, and today we've covered, or we've called our presentation Trade Wars in light of some recent events, of course with Gary Cohen, one of the long-standing, and when I say long-standing, he's lasted a lot longer than some of his peers, of Donald Trump as a top economic advisor resigning, and some sabre-rattling in return from the EU announcing tariffs on things such as Harley-Davidson's, Levi's, and bourbon. We thought might warrant. I'm not too sure how much impact that's going to have, but anyway, we'll jump into it. So, as an agenda for today, we're going to have a quick review of some previous efforts of protectionism, and in light of that, in the 1930s, we'll roll into some a look at, I guess, the trade comparisons of the United States and China at present, and then we'll of course look at the Great Depression redux. So. Is this the same or is it different? And then finally, as always, we'll be hearing about some thoughts that are going on from our investment team in terms of looking forward and how we run money at Nucleus Wealth. So on that note, we'll jump into it and I'll welcome David. Hello, David.
Hi, Tim.
And so we've got here quite an interesting graph. We've called it Down the Plug Hole. Do you want to just run through what this one's giving us?
Sure. This is a very famous graph derived from, in this case it says League of Nations, but the original where I first saw it was in Charles Kindleberger's very famous book on the Great Depression, and it depicts what transpired from 1930 on with the Smoot-Hawley tariffs in the US, which obviously shut the US border on a lot of imports, and then there was, a kind of cacophony of responses around the world, and as you can see, it developed this vortex into the plug hole that is global trade did.
Sure.
And it took down a lot of global growth with it, and that's what that spiralling chart shows you basically over the subsequent 3 years. So that's quite a commonplace description for how the Great Depression transpired and went global, aside from obviously the initial financial shock.
Yep.
And then the implications of that for consumption and asset prices, etc. The trade channel is often thought of as one of the most or strongest channels of contagion that made it much more worse and much bigger and global. So it's an interesting frame of reference to use when we're looking at today and the possible revival of tariffs coming out of the US. I think Kindleberger's frame of reference is very good.
Yep.
on this, and he doesn't actually blame trade or the reduction in trade for the Great Depression. What he actually sheets at home to is the geopolitical structure of the day, which triggered the tariffs.
Okay.
In his view, and that's where we kind of find some startling parallels with where we are today when we use this frame of reference. It was a case of the British being the dominant but declining economic power of the day, the global hegemon and economic power, coming face to face with the rising power in the United States. And the US was running big trade surpluses,
Yep.
and the UK big deficits. And Kindleberger basically argues that this tension between these two of a fading glory or a fading empire,
Yes.
combined with a rising but immature empire, left the world without kind of global leadership on economics and trade. And he calls it basically the loss of an economy of last resort.
Okay. Yep.
So that means that there was basically no one to step up and step in when these trade erections began to actually say, well, we're not going to do that. We're just going to stimulate domestically, and we're going to suck in imports and support the global economy. No one of sufficient magnitude to do that anymore, as the British had done a number of times through the 19th century.
Okay.
Not always, but sometimes. And so the parallel with today on that front is fairly obvious. We have the still, kind of supreme power of the United States.
Sure.
But with its, rather peaky-looking economic problems that have become, much more crisis-oriented in the last decade, excessive debts and both public and private, and wealth inequalities, rise of interests, etc. Being the fading empire, as it were, trading on huge current account deficits.
Yep.
And that position starting to throw up quite a lot of political trouble for the leadership of the day for those reasons, that you've seen, immense kind of levels of offshoring, jobs flying from the US to the emerging world.
Yep.
And all of those usual suspects that have, now kind of generated a fairly unpredictable and volatile Trump regime that, is not really looking like an economy of last resort, even though it still is today the global engine of growth. It's kind of really bridling under the pressures of that. And then on the other hand, you have the rising power, which is, unscrupulously yoked its currency to the US dollar for many years, sucked out, a lot of its intellectual property and its productive capacity.
Yep.
Which is, we have to ask ourselves: is it the US of the 1930s where it's unable or unwilling to step in if the US does close its borders and take the global leadership of advancing global trade?
Yep.
And so that's the analogy, I guess, through which we're going to look at this problem today.
Okay. Yeah, sure. All right. Very good.
So I guess that's the primary similarity. There are a bunch of differences that make it look less threatening today than it was in the 1930s. At this point, we're not in the middle of a financial crisis.
Yep.
Obviously, for instance. And so some of that politicking is much less volatile and pressing.
Sure.
Smoot-Hawley was out within 12 months of the 1929 crash. This time we're obviously nearly a decade after the
major correction.
The great crash in 2008.
Yep.
And so, as a result, mulling tariffs at this point is much more of a chronic than it is acute problem. In terms of implications for growth, probably in terms of political fallout as well.
Yep.
we also have, we've got another chart in there somewhere. It might be the next page. This one, yeah, where we also have this position where the globalisation of today is much larger than it's ever been before, and that has generated its own architecture.
You want the following chart?
No, that's it.
Okay. Yep. Sorry.
And we can see. Sorry, you've gone too far. Oh, that's one. Right. Sorry about that. You can see that global trade as a proportion of global GDP is much higher than it ever has been. That's created a much stronger architecture in support of global trade than we had in the 1930s, when we only had the sort of rather vulnerable League of Nations, and now we have this extraordinary web of international legal institutions that support trade. That doesn't mean Donald Trump can't do what he wants to do. He can, in fact, do it through various privileges he has as the president. He can do quite a lot of damage, in fact, through various declarations, largely through strategic mechanisms.
And just quickly, that's an interesting point, though, because obviously there's declarations that are being made at the moment as opposed to actions, and we'll probably speak a little bit more about that in regards to investment. But just touching on before when you were talking about the web, so rather than there being sort of two powers, one receding and one sort of needing to step in but not, from a current day perspective, is it going to be a case of everybody taking a step back and leaving Donald out in the cold, or do you think it's is it going to be something more to it than that?
Well, I mean, I guess that depends how far he goes. The only actual stuff we've seen so far on steel and aluminium is minuscule and is in fact largely branding.
Yep.
President Obama already shut down the Chinese steel trade into the US. Although it has been diverted to some extent via Canada and Brazil.
Okay.
But he basically shut it down. So the steel tariff, which is the bigger one, isn't going to do bugger all really. And even the US Trade Secretary admitted that they were only trying to raise steel utilisation capacity by about 7%, which is like 7 million tonnes. It's not much.
Okay, sure. Damien, you've got something there.
And it's worth noting as well that when you do raise tariffs, you generally don't. It generally doesn't put it out the person who you're aiming the tariffs at. So let's say if you're the highest cost producer, you're going to end up putting the second highest cost producer out. So what will happen is the steel will just be diverted somewhere else. So for example, in the case of the US one, if the steel that was going directly from China to the US, given that China is one of the lowest cost producers, basically went, okay, US erects some tariff barriers on it. That means now the Chinese steel ends up going to Europe instead, and somebody in Europe closes down because they were the next highest cost.
So it shifts the chain around a little bit.
And so it is important to note that you're not. It's not always, and it's actually usually not putting out the person who you're targeting it at. It's putting rather than the highest cost producer going out of business, it means it's the second highest cost producer that goes out of business.
Right.
And things just get shuffled around the world in terms of where it goes. And so that was what, as David was saying, the steel that was used to be produced in China and sent to the US now gets produced in China, sent to Europe, and the European steel ends up somewhere else or goes out of business, and then some Canadian steel ends up in the US, and which means that now China needs to send some more steel to Canada as well, and a bit of steel to Brazil and Brazilian steel, and so it just sort of all shuffles around the world.
And I guess there was sort of talk I was reading today about how America's, having this selective tariff approach as well. So is that just going to exacerbate the problem because it'll just mean that, effectively the market will just correct elsewhere? And
pretty much. There's an interesting parallel between the carve-outs, as they've been called, on steel and aluminium for strategic allies of the US versus what China is already doing in its one belt and one road stuff.
Yeah, sure.
Which they're not directly parallel, but they have a similar philosophy in a way where they're investing heavily in allies ahead of others.
Sure.
In terms of trade. So it's a kind of strategic shift in trade flows.
But it's very, very visible in the sense that it's on the front page of the news as opposed
that's
to
right.
at the back of an agreement.
And it will be distortions rather than necessarily actual cuts.
Mm-hmm.
So I mean, yes, China and aluminium, steel and aluminium are real, but not highly impactful.
Yep.
What's got everybody spooked was Gary Conn jumping ship, and then there's also some rumoured from Bloomberg material about plans for some further big tariffs to be placed on China much more broadly.
Okay.
And we don't know what the substance is of those. Trump's new advisor is not yet appointed. It's not going to be Peter Navarro.
Oh, right. Okay.
We know that much. That was released this morning.
Yep.
So that is a big let-off.
Mm.
He's the major China hawk in the administration. It's at this point we just don't know how hard Trump's going to go on this. Reading Trump's mind is it's a bit of a labyrinth, to say the least. But I guess what the point of comparing these two periods is, even if he does go down this path to some degree, it will be difficult for the US to generate a great deal of distorted flows.
Okay. Yep.
And the other question I've got is if the US did decide to in a big way go it alone and erect a bunch of trade barriers, the question is, will the rest of the world then tit for tat versus each other, or is it a matter of maybe there's we'll put a tit for tat in, as I said, Harley Davidsons and Levi's and Bourbon type things, but let's open up some new trade routes with China, and let's open up some new trade with the rest of Asia, and so whether you actually see that the US actually ends up a bit more isolated in terms of those strategies, and given the Republican Party is generally pro trade, I think the most likely outcome does seem to be at the moment that it'll be a lot of noise, but not a lot of actual action behind it. A few big high-profile things like steel, and you can get some great shots of Trump in a hard hat standing next to cheering steel workers and all that type of stuff. But if that's what if you get half a dozen of those types of things and that sort of lead to more jobs for America and all these great statements, but actually make very little difference to the overall trade, I think that's, from Trump's perspective, is actually probably a big win for him. I don't ruin the economy, but I get to stand up for the downtrodden workers but not actually have to do too much actual real work.
So it's a little bit of political pantomime in there with not a lot of substance potentially as well.
So far, yeah. It does appear Trump's instincts, such as they are for protection, but as Damien says, there's no one else with him.
Yeah.
There's a few people in the White House, but the Republican Party is very pro-trade.
Mm.
That said, he can do quite a lot unilaterally from the White House.
Unabated, yep.
So, I guess that's our base case then, is that this is largely branding.
Yep.
But I thought we might as well take a look at what it would look like if they do go a bit harder, and what will the rest of the world do, in particular China, given any further tariffs are likely to be aimed squarely at China.
Yep.
The steel ones appear to be, but actually aren't, because that trade's already dead.
Sure.
So we kind of come back, we have this enormous deficit here for starters, which is why, it's a bit of a target for China. China is a bit of a target for Trump. There's a few possibilities in this which are encouraging. One of them is US shale oil, which is booming, extraordinarily booming in terms of output, and has started to export for the first time in many decades. And China is becoming a much larger oil importer.
Okay.
And will increasingly be so. So there's one big and quite swift offset potentially there. China could start buying a lot of US oil as a way of kind of wedging it on its trade stuff, the way it's very successfully done by buying Australian iron ore and our soul in the process.
And keeping in mind, this is again doesn't need to be doesn't need to be like something brand new in terms of China creating extra demand. I mean, they've already got this big internal demand, and they're already buying a lot of oil from Saudi Arabia. The question is, if they shifted a lot of that oil and started buying it from the US, the net effect for China is very little. There might be a couple of cents in paying a little bit extra for the transport. But if in that mind that cuts sort of the legs out of Trump's arguments, because China's basically got the same oil they would have bought. The oil from Saudi Arabia, rather than going to China, has ended up in Europe.
Yep.
The oil that the US would have sent to Europe has ended up in China. So net, there's a tiny little bit of extra transport costs, but US trade deficit with China decreases quite significantly.
Yep. Yeah, sure.
Is actually a pretty good political win for China if that's the way, and it does look like that's the way they're pushing.
Yeah, right.
But that sort of really gets rid of a lot of this deficit without actually doing very much at all.
Okay. Yep.
That's one thing they could do. Other things, I mean, if we do get into a trade war, then they can let the yuan fall, which would be disastrous for everybody.
Yep.
That would be pretty much an end of cycle event, I think, because you would then have both United States trade flows being truncated and China choking off any bid for emerging markets.
Oh, right.
That's precisely what happened in 2015. That scenario would see a US dollar soaring and emerging markets getting crushed, basically, and you'd get a big global shock if that happened. So I don't think it's likely. I mean, China's gone to extraordinary efforts to stabilise the yuan over the last few years, basically slamming shut its capital account.
Yep.
Which they didn't really want to do, but they've had to, because the world basically just can't handle a more competitive China. It blows it up.
It's had enough.
Yeah.
And also as well, China really wants to get its consumer going, and it needs to convert from this sort of debt-driven infrastructure boom into consumers actively
middle class,
spending more,
growing middle class,
and them actually spending more. And part of that means a higher yuan, because then at the moment, if you can't import anything in China because you can't afford to,
your
currency rises 10-20%, all of a sudden there's a lot more goods you can afford from offshore, and so helps consumption internally, reduces, it's
keeps everybody happy, fat and happy.
And it's a good fix for their own internal imbalances as as well.
Yeah,
So if they let the yuan fall dramatically, that sort of puts those imbalances back out of whack again.
Okay, yeah, sure. All right.
I mean, the other thing people mention, of course, is the dumping of US treasuries, but that's effectively the same thing, and I don't think they're going to do that either. Can they sort of step up as this economy of last resort, as we discussed in this, kind of Kindleberger frame of reference? Well, it's pretty difficult. I mean, as Damien says, yes, they need to keep kind of this transition to the consumer. That's their best bet.
Yep.
But at the same time, they've got this internal indebtedness problem of their own, just through this hyper growth that they're trying to deliver and address.
Yep.
And so it's pretty tough for them to stimulate heavily internally in that context.
Some more fuel on the fire.
Yeah, and I mean, then on top of that, you've got to add the new emperor, Xi Jinping, and what serves his interests.
Sure.
In this, if he is going to be a lifetime ruler, then it really is about his interests rather than anybody else's. How would his interests be best served in this trade war scenario? Obviously, having an external enemy probably is not a bad thing for an emperor, but at the same time, it can't really allow the interests that support him to get hammered.
Sure. Yep.
So again, it's probably some form of internal stimulus, but not likely rate cuts. More likely more fiscal spending, but not. Again, you've got this deleveraging issue, so kind of more of what we've seen: foot on the brake, foot on the accelerator.
Hope for the best.
Investing, in infrastructure and things, but not letting housing bubbles to run away again and stuff. So they're not in a great position to do it, I guess, is the point. not in a terrible position, but not great.
Okay. Yep.
And you could argue they already did in following the financial crisis.
They did,
Yeah, was that they actually they were the economy of last resort in that they spent a huge spending program and ramped their own debt up and things like that. And the question is now, do they do that again? In Australia, we look upon this as wasn't that a great thing coming out of the financial crisis?
Relatively unscathed.
China spent all this money on infrastructure, huge rise in demand for iron ore and coal and everything like that.
Yep.
And that saved us. Wasn't that a great thing? Surely they'd do it again. That view isn't the same in China.
Yep.
Going out and building all these roads that people aren't using, or spending all this money and going into vast amounts of debt for and having infrastructure that's not used to capacity was sort of yes, okay, we made it through and we didn't we were relatively unscathed, but we've still got this huge debt overhang from that. So rushing out and doing the same thing again isn't the sort of top of mind for them.
Yeah, sure. Yeah, certainly. Yeah, the overcapacity sort of angle is just not something you're going to be building even more of to just placate the rest of the world. Doesn't sound like a...
No, it's difficult for them to do it. So I mean, if Trump does go that way, it will be very difficult for China and everyone else, which is probably a good stepping off point for looking at the economic implications for more widely, if in various scenarios. I mean, your base case for when you get protectionism is that it'll boost inflation in the tariffing nation.
Sure. Yep.
But how much? Depends very much on how widespread those tariffs are. We're obviously living through the low inflation period. We don't see any end to that structurally, although currently in the US we have cyclical price pressures.
Yep.
But we expect them to abate relatively quickly.
Okay.
Either as oil comes down or as the cycle winds down.
Yep.
And when you say price pressures, we're talking about we're out of the bit where we're worried about inflation being too low, and we're getting to the stage where we're going, well, maybe inflation's all right at the moment.
Okay.
It's not in any way at a concerning level. It's just they have a 2% target, and it's been under the 2% target for a long time, and now it's actually it's poking its head above that 2% target, but just above it, and so it's not sort of a look out, here comes inflation. From our perspective anyway, there are people who run the story that there's all this latent inflation in the system and it's about to explode.
Sure.
Our take is that no, there's a number of structural imbalances and the high debt loads and the inequality in terms of both wages and sort of assets that's going to prevent that from being a huge inflation blowout.
Okay, sure thing. All right, so
there's also wage inflation there, which is firmed up, but it's still far from tear away. And even the freshest data is showing that it's firming, but it's not ripping.
Yeah, sure. Okay.
So that means that they basically could handle some protectionism without really generating any kind of inflationary pulse, as long as it's not too widespread. So I mean, on the forex angle of that, is it US dollar bullish or?
Yeah, that'd be interesting to get your thoughts on.
Bearish, which has a very, very large impact on everything. At the moment, it's bearish for the US dollar.
Okay.
Whenever it comes up, the US dollar gets a belting because it's more or less trading on the political risk rather than the economic implications.
Okay.
But if you do get more of it, it will be inflationary, and you would expect that to actually be US dollar bullish. And because it's also deflationary for elsewhere, so you get this double whammy. So hard to know on that one. I mean, some people are arguing that gold is a good hedge here. I'm not convinced of that, basically because gold is pretty much just a US dollar play one way or another.
Sure.
And I think if you got sustained tariff action around the world, you probably would see a stronger US dollar. But I mean, either way, I'm not sufficiently persuaded of the case to recommend gold as a hedge against it.
Okay.
If we got more tariffs, it would obviously be bad for stocks, I think. We've got high valuations. We're in the middle of a profits boom. those valuations would simply have to price greater risk to earnings out of tariffs, as growth would be considered to take a hit.
Yep.
Interesting question on bonds. Could actually be a double whammy there, because if you're going to boost inflation, there'll be some self-correcting in this. Could be short-term bearish for bonds, but then longer-term bullish.
Mm-hmm.
If stocks came off, then they might put the bid back into bonds.
Yep, sure.
So bonds could be a safe haven over the stretch, when initially they take a hit on that higher inflation. Hard to say. And sort of finally on Aussie assets, it's just all bad. Small open economy driven very much by commodity prices. Small open, heavily indebted externally
Mm-hmm.
economy. Hyper sensitive to interest rate movements and commodity prices. Tariffs is as bad as it gets.
Yeah.
Stronger inflation, higher interest rates internationally. At the same time that commodity prices take a hit from growth prospects, a possible rising US dollar, and even things like direct impacts like steel. If you did get a reasonable uptake in US steel, 20 million tonnes, say, shifts to the US from elsewhere. The US is nearly all arc furnaces,
Okay.
and that's all scrap driven.
Yeah,
so
sure.
you're actually displacing 30 million tonnes of iron ore.
Yep.
Brazil's a lot closer.
Sorry?
Brazil's a lot closer as well.
Yeah, and Brazil's a lot closer to ship iron ore.
Yep.
So you'd be shipping, you'd be shifting a material amount of iron ore in terms of trade flows. So that's a risk as well. But basically, Australia is an almighty sell if this tariff war gets going. That's one reason to think that the markets don't really see this going very far, because the Australian dollar hasn't really taken it in the neck.
Yeah, sure.
On the back of this, it's been pretty quiescent. So.
And as always, and with this actually rolls just nicely into our final slide on investment thoughts. But Trump can tweet things, but that doesn't always necessarily mean it's going to happen. Did you have some notes on that, or we hand over to Damien for the investment review?
Yeah, I think one of the things on the investment side is very much that first point. Yeah, look, Trump tweets a lot. He reverses his position frequently. Even often within the same sentence.
It's brainstorming done at a national level, essentially, isn't it?
Yeah, that's right. So I think obviously an investor's view, before the last sort of 2 years ago or earlier, you'd take pronouncements from governments quite seriously and what was going to happen, and spend a lot of time sort of trying to work out what the effects would be. Unfortunately, at the moment, we need to take the thoughts that come out and the tweets that come out and treat them with a lot less
gravity.
Absolutely. And so having said that, though, it doesn't mean that's not going to happen, and there certainly are risks around these. And so the idea for me is very much is this: you need to have a plan. And so the thing is, you can't wait until the day that that it is announced.
It does happen.
And it does happen.
Sure.
To suddenly decide, oh no, what am I going to do? What am I going to buy? What am I going to sell? That's the panic stage of oh no, things are falling. I need to get out and all that type of stuff is not when you want to be making your decisions. You want to have your decisions made now as to what you're going to do if this happens.
Yep.
And so we've had a decent run through stocks in our portfolio and asset allocation and exposure to Australian dollar versus US dollar versus euros and things like that. And that's where we sort of feel that the plan sort of pre-done, pre-written. If this happens, if we see an escalation, if we see, a figure that's put into a position that is, that someone like a Navarro who was going to push through tariffs and try and actively start trade wars and things like that, is that there are a number of stocks within our portfolios we'd need to sell.
Yep.
And we're not sort of on the back of a Trump's tweet. We're not jumping out and selling those stocks and switching out, but we do have those sort of lined up as, right, these are the stocks which we need to seriously consider holding or not holding.
Yep.
And there's the assets we need to look at, whether we're pulling back on stocks, or are we picking up on bonds? Are we going to cash? Those types of things are all sort of pre-done, and sort of a discussion's been had and a decisions have been made. And that's what I'd urge most people to do, is that with any risks like this, don't wait until it happens to make your decisions, because that's when you'll make poor decisions, or assets prices falling will overly influence you into what you're doing, whereas you pre-decided, here's my escape routes, work way better than the panic and rush for the closest exit.
The knee-jerk reaction. Yeah, sure. Okay. I guess you sort of covered off there. So from an equities point of view, we touched a little bit on bonds, and obviously, we use Australian government bonds. Do you see, is there any risk at all in our sort of trade, the assets we hold in our more defensive positions, vis-a-vis Aussie bonds? Is there going to be a rush for the exits from external equity or capital rather leaving the market?
So the issues, as we spoke, there's sort of two issues. One is on that US dollar versus Aussie dollar question, and also Aussie dollar versus euro and the rest
everywhere
of the world.
else. Yep.
Is that our expectation is that the Aussie dollar would be particularly weak. So that's an argument towards holding either foreign cash or foreign stocks or foreign bonds. So we feel as if there's a decent amount of hedging. We're pretty overweight international at the moment, certainly relative to Australian stocks, and so there's a bit of hedging in the initial stages you'll get from that. Within the bond side, really comes down to the inflationary expectation. So if there is a real inflationary push from this, we're not expecting one, but if you do start to see real inflation kick through, then you'll certainly see weakness in bonds.
Sure.
And quite possibly the initial, as David said, the initial stage of bonds would be that inflation would be expected, and so the bond prices would fall.
Yep.
Our take is that's probably a buying opportunity. We don't think the inflation. We think the rest of the structure of the world is lack of demand, and that it would actually
the
be,
sugar hit's not going to last long enough for to be worth investing or trading.
Yeah, and the danger of the world sinking into sort of a more of a slump and more another recession because of lack of trade is bullish for bonds. So you actually would want to be buying bonds, but the question is whether you wait for that initial concern about inflation to pass first.
Yep.
We'd probably end up with a bit of a bit each way.
Yep.
We'd have a decent holding in bonds, and then look to buy more if they fall back.
Sounds prudent.
I mean, basically, some people are arguing this will end in stagflation, where you'd have crap growth and rising inflation.
Yep.
Which would be very bad for bonds. But as Damien says, we don't see the structure to support that. I think even if there were an inflationary bump, it's unlikely to be sustained.
Okay, sure, right.
But it is a risk. So,
sure.
Certainly one of the key risk we'd be looking at in our is it, do you get that inflation take off, and then cash is sort of cash is king, I guess, in when this pops out.
Yep. Okay. And also, I guess, just finally for and obviously people have got a natural, well, hopefully our listeners anyway, have got a natural Australian bent, and we do need to own, in some of our portfolios, some Australian exposure. Do you see a potential trade war washing out into Australia? Do you think we're going to participate in a trade war per se? And an example being, obviously with the recent with the iron ore, and Rio have come out and said that it won't impact them too much, but at the same time, is being beneficially looked after by a smaller client worth annoying a much larger client in China? Is this sort of something that we need to think about from a sector point of view, perhaps in the Australian market, or is it just going to be on we power, and if someone can't buy our produce or our goods or our hearing aids, does it it leaves the rest of the world to move into?
Yeah, I mean, it's unambiguously bad for Australia in general. I mean, as David said, a small open economy with dependent upon foreign investment, and is trade wars are where the ground zero for where the damage is going to get done. So it's really about where you can find safety in that case in Australia.
Okay.
It is an argument for more overseas assets. It's an argument for buying the stocks that are sort of global stocks that do have operations in many countries and operate out of, because I think that the tariffs in the end aren't coming down to where your headquarters are.
Yep.
They generally will come down to where if there's a factory in the US producing something and selling to US customers is unlikely to be hit by those tariffs.
Right. Yeah, that's an interesting thought.
So if you're a multinational, then you're all right. If you're producing in one country and trying to ship, that's where you'll most likely get hit by the tariffs.
Okay.
And so so we're looking for companies that are offshore companies generally, actually not too dissimilar to our current exposures.
Okay, no, very good.
Well,
David?
just to add, I think there's zero chance of Australia responding with counter tariffs
Yep.
on anything. It would be so foreign to the political economy that it doesn't pass the laugh test.
Yep. Okay. Very good. I've just had a question come in actually, and I'll leave it open to either or. But how do you see the effects of the reversing of QE, as in asset sales held by central banks? Give you a moment to think about that. Bit of thinking music, perhaps.
Yeah, sure. So I'm assuming this is in relation to the trade. I think that central banks are going to be, if trade wars break out, central banks are going to be pretty keen to step in with some extra stimulus, or to at least delay the stimulus delay the withdrawal of
winding back.
Stimulus would be my take. Is that I think most central banks around the world are pretty pro-trade. We've already had a few central banks come out and talk about the increases in tariffs in pretty disparaging terms, and their thought process will be, well, if this is what's happening in the political economy, we need to do more on the monetary side, whether it's lower for longer or more QE.
Yep. Okay.
A couple of Fed governors already said that last night.
Sure.
As well, that this was an unknown quantity for them that immediately watered down their hawkish outlooks.
Yep.
At least muddied them, and so they were more cautious.
Okay.
And that may account to some extent for the falling US dollar initially on it as well. Yeah,
right. Okay. Very good. Well, thanks, gentlemen. Any final closing notes, or we're pretty happy with that for now? Looking good. Okay. Well, look there. Thanks very much for a wonderful run through at the present stage of what could be an impending trade war. We'll wait and see. And thanks for your attention. What we'll do now is we'll just quickly jump into a little bit about Nucleus Wealth and how it can help you. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. And stay tuned for next week, of course, for our next instalment of Nucleus Insights, which is our continuation of our Quant Rocks for Picking Stocks mini-series, I guess, essentially, where we'll be deep diving into one of the key themes of quantitative analysis, which is the quality side of assessing the particular equities and companies. That's same bat channel on Thursday, the 15th of March at 12:30. And if you're interested in that, please head over to proton.nucleuswealth.com to register your interest, and so we can give you some email links and bits and pieces, including, of course, our little feedback questionnaire, which Maddie will send out to anyone who's registered today. Just gives us the opportunity to feel the pulse on how you think we've gone today, and also give us a little bit of direction for future webinars. And on that note, I'll thank you very much for your attendance, and I hope you got something out of it. I certainly did. And we look forward to catching you at the next one. Cheers.